Of the most important banking interview questions, walk me through a DCF and how you answer it. A discounted cash flow is an evaluation method to estimate a company's intrinsic value by projecting their future free cash flows and discounting them back to the present value using an appropriate discount rate. So step 1 of the discounted cash flow is projecting stage 1 unlevered free cash flows, which is the cash that the business generates before considering debt, while it's still in the non-mature phase of its life cycle. So projecting revenue and operating costs will get you EBIT, tax affected to get the NOPAT, which is net operating profit after taxes, then add back non-cash charges like depreciation and amortization, and then subtract capital expenditures and adjust for changes in working capital, and this will give you the unlevered free cash flow for each forecast year, which is the core driver of the company's intrinsic value. So step 2 is calculating the terminal value, which reflects the value of the business once it reaches the mature phase of its life cycle. And because you can't forecast detailed cash flows forever, you rely on 2 methods. The first is the perpetuity growth model, where you take the final year's unlevered free cash flow, grow it at a sustainable long-term rate, and divide by WACC minus that growth rate. Second, you can choose the exit multiple method, where you apply a market-based EV divided by EBITDA multiple to the company's final year EBITDA. In practice, you want to calculate both, but one tests long-term fundamentals and the other ties your valuation to market comparables, and you use them to cross-check that your assumptions are realistic. So step 3 is discounting the cash flows back to their present value using the WACC formula, or the weighted average cost of capital. This reflects the required return for both the debt and the equity investors, and because you're valuing unlevered free cash flow, WACC is the correct discount rate since those cash flows belong to the providers of capital. Discounting adjusts for the time value of money and the risk profile of the business, converting long-dated cash flows into today's dollars. Once you discount everything, you sum those present values to get the enterprise value, which is the purchase price of the business. So step 4 is just calculating equity value. The enterprise value represents the value of the core operations, so you're just adjusting for the capital structure. So by subtracting debt and adding back cash and account for non-operating assets or liabilities, what's left is equity value, which is the portion of the business that actually belongs to shareholders. So the final step is just getting the share price. You're taking the equity value you just calculated and you're dividing by the number of diluted shares outstanding. That is the final figure and is the implied price per share from your discounted cash flow, which is what the business is worth on a per share basis.